Welcome to vTalkInsight, Allocator's Lens Daily for February 17th, 2026. Cross-asset markets are trying to reconcile a Goldilocks inflation backdrop with rising volatility from artificial intelligence and geopolitics. Equities are rotating beneath the surface, even as headline indices stay resilient. Rates are repricing the path of cuts, and credit still looks unusually calm. Let us begin with equities. In equities, the backdrop still looks surprisingly supportive even as risk feels higher. Softer than expected U.S. inflation has reinforced the Goldilocks mix for growth in prices, and double-digit earnings growth underpins expectations that major indices could grind to new highs over the year. At the same time, implied volatility has pushed back into the low 20s, and the artificial intelligence story has shifted from a straightforward tailwind to a major source of dispersion. AI adoption is forcing a rethink of who really benefits. Recent advances in AI have not taken the main U.S. technology benchmark to fresh records, and software names have been hit as investors struggle to separate durable, AI-enabled business models from firms that may be displaced. Valuation risk is elevated in parts of tech, while shortages in memory chips and sharply rising drone prices point to margin pressure for some hardware producers. That mix is encouraging a rotation away from U.S. megacap AI leaders towards sectors and regions whose earnings are seen as less hostage to a single theme. Those flows are visible in both sector and regional leadership. Emerging market equities, particularly in Asia excluding Japan, are drawing their fastest inflows since 2019, helped by attractive valuations and meaningful AI exposure without U.S.-style multiples. Korea stands out, combining government efforts to boost equity valuations with strong defense and AI-linked industries, while India offers roughly 15% earnings growth driven mainly by domestic consumption and easing inflation. In Europe, the absence of a dominant IT sector but strong performance in financials and industrials makes the region a natural destination for investors trimming U.S. tech and dollar exposure. European banks are outperforming, while miners and basic resources see profit-taking after a powerful run. Japan is the main soft spot, with weaker fourth-quarter growth weighing on sentiment and reinforcing expectations for more fiscal stimulus. Across this patchwork, the equity story now hinges less on the index level and more on relative winners and losers, as allocators watch upcoming labor and inflation data and Federal Reserve communication for any sign that the soft landing narrative is giving way to a bumpier, AI-driven repricing. Turning to rates, the key question is how far central banks can ease without reigniting inflation or destabilizing long-term funding costs. Recent U.S. inflation numbers came in better than feared, triggering a rally in government bonds and reinforcing the idea that disinflation is progressing. Labor market data show limited wage and hiring pressure, which reduces the risk of a wage price spiral and supports the case for fixed income as a portfolio hedge. Yet inflation is not back at target, with underlying measures still closer to 3% than to the 2% goal, and components such as gasoline and chips could push higher again. Against that backdrop, pricing along the curve roughly embeds 2 Federal Reserve cuts, but views around that path are diverging. Some emphasize the resilience of growth and argue the Fed may only deliver one move this year, while others see risk skewed toward more dovish outcomes if upcoming jobs and activity data disappoint. A separate worry sits at the longer end of the U.S. curve. If the Fed were to cut aggressively while growth stays strong and fiscal deficits remain around 7 to 8% of GDP, one scenario has long Treasury yields spiking back toward 5% as investors demand more compensation for inflation and heavy supply. Positioning along the curve is adapting to these crosscurrents. The front end of the U.S. curve is viewed as an effective hedge against both AI-driven labor disruption and the risk of overinvestment in technology, since weaker growth or a policy error would most likely be reflected first in short-dated yields. In Europe, by contrast, the central bank is in no hurry to cut despite currency and inflation pressures, leaving real yields close to decade highs and helping attract substantial flows into European bond funds and exchange-traded products. Local currency emerging market debt is also in favor, recording the strongest year-to-date inflows among fixed income segments as investors look for yield and diversification in a world where the dollar and the Fed no longer fully dominate the cycle. Credit markets remain remarkably benign given the macro uncertainty. High-quality corporate issuance is being met with strong demand, particularly from large technology and AI-related firms funding growth plans. Recent deals have been absorbed smoothly, spreads are tight, and this financing is generally seen as grounded in real investment needs rather than speculative leverage. Many allocators are leaning into investment-grade credit as a portfolio diversifier, partly because fiscal risks and rate volatility make government bond markets in the US and UK feel less predictable. At the same time, the AI theme runs through credit markets differently than in equities. Heavy capital expenditure plans are being funded largely through debt, and the market is comfortable so far that these borrowers can service what they raise. However, there is unease that aggressive AI spending could disrupt existing business models without necessarily delivering the returns equity holders expect, which would leave bondholders focused even more on balance sheet strength and covenants than on headline growth stories. Beneath the surface, the main fault lines lie outside public bond markets. Regulators highlight big data gaps around private credit and non-bank financial institutions, and they note that banks have more than $2 trillion of lending and commitments into that ecosystem in the U.S. alone. Political momentum currently favors deregulation, so supervisors are relying on voluntary disclosure rather than new rules. For allocators, that combination of tight public spreads and opaque risks in private structures argues for close attention to liquidity, counterparty exposures, and the possibility that any shock in leveraged or niche credit could feed back into the broader system even if core investment-grade bonds still look fundamentally sound. Foreign exchange markets are where many of these themes intersect. A gradual diversification away from the U.S. dollar is visible in flows into Europe and emerging markets, helped by softer U.S. inflation data and the perception that the Fed is moving closer to an easing phase. For emerging economies, the influence of U.S. policy and the dollar remains important, but is less dominant than in previous decades. A weaker dollar and lower global rates still provide a tailwind. Yet local fundamentals and structural stories, such as AI adoption, now play a larger role in driving returns. In Europe, the currency story is tied closely to policy and geopolitics. Despite inflation and currency pressures, the regional central bank is in no rush to cut, and that patience, combined with increased defense and infrastructure spending and a push for deeper integration, is seen as medium-term support for the euro. Discussion about some Nordic countries potentially joining the single currency, even if still speculative, reinforces the sense of a broader euro area backstop. By contrast, weaker recent growth data in Japan have softened the yen and steepened the domestic yield curve as investors price in more fiscal stimulus and a very gradual policy normalization. Within this mix, currencies of countries such as India and Korea benefit from both solid domestic stories and from being less tightly linked to the U.S. tech and dollar cycle, giving allocators additional levers for diversification. In commodities, two stories dominate: the evolving role of gold and the way AI is reshaping demand for key inputs. Gold has just seen a setback, dropping about 1% and slipping below the 5,000 level, which points to waning safe haven demand in the very near term, even as risk premiums from geopolitics remain elevated. At the same time, central bank buying is still described as robust, and gold continues to feature as a portfolio diversifier, although its correlation with equities has risen, which slightly dilutes its role as a pure crisis hedge. Industrial and resource sectors are far more volatile. In Europe, basic resources stocks have delivered strong gains year-to-date, but are now under pressure ahead of earnings, with some profit-taking and sensitivity to softer metals prices after Asian market moves. Underneath that short-term noise, the AI build-out is creating a more structural shift in commodity demand. A severe supply-demand imbalance in AI memory chips is pushing some prices an estimated 60% higher quarter-on-quarter, and hyperscale data center operators are planning hundreds of billions of dollars of capital expenditure this year. Because fabrication capacity takes years to add, that translates into sustained demand and pricing power for selected metals, energy inputs, and specialized materials. Combined with efforts by Western governments to rewire supply chains away from concentrated foreign providers, particularly in China, this suggests commodities will remain a key transmission channel for both the AI theme and for strategic competition, even if headline inflation stays contained for now. Stepping back across assets, The picture is of an environment that still leans toward a soft landing, but with wider error bands. Equities are supported by earnings and a friendlier inflation backdrop. Yet AI, uncertainty, and regional divergences are pushing capital toward more idiosyncratic stories in Asia and Europe. Rates markets are balancing disinflation and labor market fragility against fiscal strain and the risk of a long-end yield shock, while credit remains a relative safe harbor in public markets even as hidden leverage builds in private channels. Currencies and commodities translate those forces into real-time signals on de-dollarization, European integration, supply chain rewiring, and AI-driven commodity demand. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.